Well, good afternoon, everyone, and thank you for joining us today for our annual year-end tax and planning opportunities webinar. My name is Bob Ingram. I'm a financial planner here at Center for Financial Planning, and I am joined by my colleague, Michael Brocavich.
Hello, everybody.
Michael is also a certified financial planning practitioner that has worked with clients for over 10 years and has served in the financial services industry for over 15 years. And on behalf of our entire center team, we appreciate your continued confidence and trust as we strive to improve lives through financial planning done right. And we also appreciate that this time of year is a busy one. And at the same time, there are opportunities out there that may help save you money in the current year or even improve your financial position longer term. And as a comprehensive financial planning firm, we understand that many financial decisions or planning strategies often do have an income tax component, and many of the opportunities discussed today may be tax related. Now, we don't want taxes alone to dominate every decision, but we do work extremely hard to provide education and guidance to help you, our clients, maximize your resources and in many cases, reduce your overall tax liability. So just one quick housekeeping item before we get started. We want to be respectful of everyone's time and to stick to our time limit here. So we're not going to be able to take questions directly during this webinar. But if you have questions throughout today's discussion, Michael and I encourage you definitely write them down. Have a thought, jot down a note, and then send them to your planner or certainly to either one of us after the webinar today. And we're happy to answer your question or at least to point you in the right direction. So with that, let's go ahead and get started. So what we're going to talk about today, first would be some of the tasks or the financial to-dos, if you will, that we need to get done before the end of the year, things you want to take advantage of, and where there's deadlines to keep on your radar. We're also going to talk through some different strategies and planning opportunities, again, to help you be able to maximize those resources. And then as good planning tries to do, we try to look at least into the future. Now, none of us have a crystal ball, but we try to understand what are some of the potential changes that could impact tax laws or different strategies into the coming year. So we'll take a look at what 2023 may have in store for us. And then we'll close and share with you some different tools and resources that you'll have available going forward to help with any of the items that we talked about today. So, Michael, if we want to get started, it's the end of the year. Time is limited. We're trying to get through as many things as we can that are important to remember. Year-end to-dos. What would be a good start?
Yeah, Bob. So one thing that we're talking to a lot of our retirees about today is their need to have to take required minimum distributions from their retirement accounts. So a lot of you out there know that if you have a retirement account, whether it's a traditional IRA, 401k, 403b, you have to take required minimum distributions once you attain an age. So at age 72, required minimum distributions need to start coming out of those accounts. So if you turned age 72 this year, you have until April of next year to be able to take those distributions. But then after that, you always have to take those distributions out by December 31st of the year. So if you don't get that money taken out, there's a little bit of a tax penalty. So the IRS will impose a 50% tax penalty on any money that you're supposed to have taken that you didn't. So for example, if you had a $20,000 required minimum distribution that you didn't take, the IRS could impose a $10,000 tax penalty on you for that. So you want to make sure that we get those distributions done.
Yeah, Michael, that's pretty significant. Certainly a big impact there for that. Now, you mentioned that the deadline or the required distribution age is 72. At one point, wasn't 70 and a half an important age?
Yeah, that's right, Bob. So the required minimum distribution age used to be 70 and a half. The Secure Act that went into effect after December 2019 actually raised that age from 70 and a half to age 72. Also, what retirees need to be conscious of is if you have multiple retirement accounts out there, you need to make sure that you're getting those distributions from all of your accounts. So typically, if you haven't rolled all your retirement accounts to an IRA, and you still have a 401k or a 403b or some sort of work retirement plan still out there, you want to make sure that you are satisfying those distributions as well. So that's because you might have to take more than one. So it's important that you work with your financial planner as well as your tax accountant to make sure that you get all these distributions taken care of.
And Michael, you mentioned the Secure Act, and that was a good point. Besides regular IRA owners for their own accounts, what about inherited IRAs? I know there were some changes, of course, that happened for those inheriting IRA accounts and retirement plans, right?
Yeah, Bob, that's a good point. So another change that's been made to the required minimum distribution schedule is if you had inherited an IRA from a non-spouse. So if you were a beneficiary of an IRA and that owner was a non-spouse, and you inherited that IRA after December 31st, 2019, you have some rule changes there. So in the past, if you inherited an IRA, you were able to spread out those required distributions over your lifetime. So you could keep that account active and you would just have to take distributions once a year, but those distributions were spread over your lifetime. The new rule now states that if you inherit a non-spouse IRA, you can only stretch that over 10 years. So essentially the IRA needs to be depleted by year 10. And so you're now no longer able to stretch it out over a lifetime. It actually really shortens up that distribution schedule for you. However, there are some exemptions to that new 10-year rule. If you inherit a non-spouse IRA, for example, if you are a spouse, so you're inheriting an IRA from your spouse, you have the ability to where you can continue to stretch that over your lifetime. And you could also make that IRA and put it in your name as well. So spouses have a little bit of advantages there. Also, that who are exempt from the 10-year rule is if a minor child inherits an IRA, they have the ability to stretch it over their lifetime. Disabled individuals and chronically ill individuals have the ability to, if they inherit an IRA, they could stretch those distributions over their lifetime and avoid the 10% rule. And also, if you're a beneficiary and you're not more than 10 years younger than the person that you inherited that account for. So if you inherited an account, you're within 10 years of the deceased, you also can then stretch that IRA over your lifetime.
And that's an interesting exemption. That some examples that we were seeing, Michael. What would be a couple? One example, let's say, for where we're seeing that happen.
Yeah, so let's say, for example, if you inherited an IRA from a sibling. So a lot of times siblings, brothers, sisters, they're within 10 years of each other. So if you inherited an IRA from a sibling and you're within 10 years, you can then stretch their IRA out over your lifetime, and you don't have to distribute it over the 10 years.
So now, if you're covered under that 10-year rule, obviously big change there. What about still having to take, the annual required distributions?
Yeah, that's a good question, Bob. There was a little bit of a gray area when this rule change first came out, and the IRS has actually further clarified that. So with the 10-year rule, it really depends how quick that schedule is over 10 years based on how old the person was that the deceased was when they passed away. So for example, if you inherited an IRA from an individual who was over the age of 70 and a half or 72, and they were actively taking required minimum distributions, then when you inherit that account, you actually have to start your required distributions immediately. So over that 10 years, you have to start taking your distributions year 1 and year 2, 3, 4, 5, all the way to year 10, taking distributions every year. Now, however, if you inherited that IRA and the owner of that IRA before they passed was not in RMD mode, meaning that they were not over the age of 70 and a half or 72 with the new rule change, then you can take that, when you inherit that IRA, you have a little bit more flexibility on when you distribute that money over the 10 years. It still has to be distributed within 10 years, but you can choose what years you want to distribute. You could take it all in year 10, or you can take part of it in other years and take breaks in other years. So there's really some planning opportunity there with your financial planner and your accountant to see which works best for you based on income at that time. And the IRS realizes that there was some confusion around this. So if you did inherit an IRA and you haven't been taking those required distributions, that's okay. The IRS is actually waiving that 50% IRS penalty if you missed your RMD in 2021 and 2022. Now, it's important to note this is only if you inherited an IRA after 2019. Does this work for? For people that are in normal, just IRA distribution mode, they still have to take those distributions, and that penalty wasn't waived for them.
Yeah,
So.
and that's a good point, Michael. That's a question that's come up to say, well, what if, does this new rule, do I suddenly have to change what I've been doing if I've already been taking distributions? And no, that those are, you're still under the old rules for having to take your distribution, but also being able to use the stretch. If you had been doing that prior to 2020, that's still available.
Yeah, absolutely. So if you had inherited an IRA, prior to December of 2019, you're still in the old rules of being able to stretch that out over your lifetime. And but those folks, they have to continue to take required distributions. So, but so Bob, I know that a lot of folks out there, they don't have IRAs, or they're not required to take distributions right now. But what are some other things people can be thinking of to help save some money at tax time?
Well, starting with folks that are still working, maybe you're contributing to retirement plans through work, or you're contributing to IRA type accounts. If you are contributing to an employer plan like a 401k, 403b, just note that you have a certain annual maximum contribution. And maybe it's, you'd really like to increase up to that maximum, if not the entire maximum. But based on how much you're contributing already through the year, through your percentage, through payroll, maybe you're not going to hit that goal. So in many cases, if employers allow for a very large percentage, maybe even up to 100% of your paychecks, you could kind of what we call power save or super save for the rest of the year. Have as much as you can from your paycheck go into your plan to try to make up for some of those contributions, get as close to that annual maximum as possible. And then you might say, well, wait a minute. So Bob, I need to live and spend money and have bills and things. Well, it works well if you have savings, of course. So you can use the paycheck to have from payroll to fund the plan contributions, and then use some cash savings you might have on hand to live on for those, those periods where you would otherwise have cash flow coming in from your paycheck. So again, some planning work there. Everybody's situation is a little bit different, but it is an opportunity. And then, if you do contribute to IRAs or eligible for Roth IRAs, the good news is you don't have to contribute to those by December 31st. You actually have until tax filing deadline into next year to make those other contributions. So you have a little bit of time. But if you're trying to contribute to your employer plan, that is, calendar based. So whatever contributions you make from payroll in 2022, that's what's going to go in for 2022. Now, looking forward, a couple of things of note. With the inflation that we've seen this year, the IRS updated very, very recently the new annual limits for 2023, and you can see that they've increased by, for example, a couple $1,000s for the 401k, $1,500 for simple IRAs, and even an extra $500 for the traditional Roth IRAs, as an example, and that's pre-age 50. There's also the catch-up contributions that have increased. Well, now is a good time as well before the year end to kind of think about and plan how much you want to contribute for the full calendar year 2023. And then you can set your percentage if you're trying to get the maximum. Make sure you've updated your percentage through payroll starting in January so that you can do that over the course of 12 months. And then maybe you don't need to be in a position to try to power save or change your contributions, year end next year. So have that in place.
Yeah, that's great, Bob. So people are going to have the opportunity to save a little bit more going into next year. Now, while lot of folks change these contributions during open enrollment. So while people are going through open enrollment right now, are there other things that they could be looking at to help save them some taxes?
Yeah, well, the open enrollment, if you're going through and selecting a plan, one of the things we talk about quite often would be the benefit of health savings accounts. Now, it's a way to save and put funds aside specifically for medical expenses. And what's nice about this is, of course, it goes along with a high deductible health insurance plan. So you have to have certain minimum qualifications for deductibles. For example, this year, minimum deductible for an individual is $1,400, for a family, $2,800, in order to actually qualify to have a health savings account. But what are the benefits? Well, we like to think of it as a term called triple tax advantage. And what do we mean by that? Number one, the contributions that you make to the health savings account are pre-tax, so they don't count toward your taxable income for the year, which is great. Secondly, it actually those dollars can grow over time. They're tax deferred. Similar to your retirement plan contributions, any gains and earnings, any dividends, and you can make investments. You open most accounts allow for actually investment funds where you can put your money. As those grow and have income, you don't have to claim the income in the year that you'd recognize it. It's deferred. Then when you take the withdrawals out, if you have a qualified medical expense, you don't pay any taxes on the withdrawals. So you haven't paid taxes on the money going in. It's been growing, let's say, tax deferred for a while. And then when you take those funds out, you don't pay taxes on it. So that really is a powerful way to put money aside, especially over the long term for medical expenses. And overall, you can do this until you reach Medicare age of 65, and then you can no longer contribute. But you can continue to use the health savings account well into retirement. You can pay for even Medicare premiums. Even certain kinds of long-term care premiums using the dollars in the HSA. And then at age 65, what's kind of nice is that not only do you have the triple tax advantage of not having to pay taxes when you take the money out for medical expenses, you can use the funds for non-medical expenses. Now, you don't get tax-free withdrawals, but you would get penalty-free withdrawals. Normally, up until age 65, you may pay a 20% tax penalty if you withdraw funds other than for qualified medical expenses. So you do have a little bit of flexibility, again, once you're even into retirement beyond age 65.
Okay, so now, Bob, I know that a lot of folks, they have choices where they could pick either a health savings account, which you described here, or some people have what's called a flexible savings account. So FSA. Yep. Could you explain the differences there?
Sure. So the flexible spending account is really designed to be used in the year that you make the contributions. Kind of think of it as, quote unquote, use it or lose it. So it's designed to be spent down by the end of the year. Now, many plans are allowed and will offer the ability to let you use those funds into the next calendar year. Sometimes March is a common deadline or the springtime, but generally speaking, it's a short term to be used in that year that you've contributed. Whereas the health savings account doesn't have that limitation. It doesn't have to be used this year or even next year or the next. It can continue to grow, and you can continue to have those dollars even if you don't need them or want to use them in a given calendar year. So offers a little bit more, certainly a lot more flexibility with similar tax benefits. But again, the one downside with the health savings account is you have to have a higher deductible plan. So in many cases where maybe a high deductible plan doesn't work for some families, then at least the flexible spending account gives another option to put pre-tax dollars away for those qualified expenses.
Gotcha. Yeah. So for people who this makes sense for, this is another great account for them to be able to save money in. Now, it's not just our working folks that are under a current open enrollment. Don't retirees, aren't they in open enrollment right now and have some decisions to make?
Yes, for retirees that are age 65 and over that are covered under Medicare, this is the open enrollment for Medicare. So from October 15th through December 7th, you have the opportunity to make some changes to review different plan options for next year, 2023. Interestingly enough, they just announced what the premium schedule would be for 2023, and even in a year where we've seen, the inflation like it's been, where we are seeing cost of living adjustments in other cases, we're actually going to see a decrease in Medicare premiums for 2023 compared to this year, 2022.
Wait a second, Bob. Did you just say that premiums are going down this year? How does that happen? Like you said, we're in inflation. We have interest rates going up. How are premiums going down?
Yeah, actually, yeah, it's not a misprint or a misquote here. Yeah, that's actually true. And it has to do more with how they've budgeted the overall Medicare fund, and how the expected budget into the next year, how it looks and compares, how they figure out what the premiums are going to be. So that's really been the cause. It's not tied directly to any one rate of inflation like CPI, like other things like Social Security benefits are. So it's a little bit of a different method for determining what those premiums are. So, again, it's a small change. So, for example, the baseline premium for this coming year, 2023, up to income for married filing jointly is $194,000. If you have a modified adjusted gross income of $194,000 or less, you'll pay $164.90. That same baseline premium for a little bit lower income for 2022, but the baseline premium was closer to like $171. So small difference, but you know what? Every little bit helps. If we can say that there's a cost decrease somewhere, it's a nice thing. So, in addition to looking at things that you have to do, certain deadlines we've talked about so far, certainly at the end of the year, looking at your portfolio, looking at your investment accounts is a really important thing, particularly in a year we've had this year with some challenging financial markets, obviously some of the economic uncertainty in the news that we're hearing. So, Michael, if we're going to do that, particularly in a year like this, review our portfolio, our investments, where do we start?
Yeah, that's a good question. It's obvious we've seen a lot of market volatility so far this year, and if there is one sort of silver lining you can say about a down market year, is it really gives us an opportunity to look at the tax efficiency of our portfolios and see if we can make some adjustments. So the accounts that I'm talking about aren't your IRA accounts or your retirement plan accounts. These are your brokerage accounts or your taxable accounts. You might have a trust or a brokerage that you're having additional investments in. This is a time to take a look at the investments that you have. And if you have things that you've held on to for a while and you didn't want to sell because you didn't want to pay taxes on it, or even if you have a fund that you've had for a while that seems to always distribute a lot of taxable gains to you, maybe now's a good time to take a look at that and rebalancing your portfolio. So one of the main things that we're doing for clients is we're looking at doing what's called tax loss harvesting. So with tax loss harvesting, what you're doing is you're looking at your portfolio and you're selling securities that are currently right now at a loss. So you're going to sell that security at a loss, realize that loss for this tax year, but immediately take that money and buy a new investment that's equivalent. So for the client's purposes, their money stays invested. But for tax purposes, you've realized now a tax loss on that investment, and you can start to bank up those tax losses. Now, tax losses, they could be used against future or current capital gain distributions. So if you have other capital gains this year, those tax losses will help offset against that. But if you don't have any capital gains to realize this year, you have the ability to now bank those tax losses and use them in future years. And there's no limitation on how long you can push those forward. They stay with your tax return. And so anytime in the future, if you have capital gains, you'll be able to use some of those losses to offset them. And the good news is if you never have any gains to offset, you could always use about $3,000 of those losses and start to offset some ordinary income each year as well. But $3,000 is going to be the max you can use to offset ordinary income. And lastly, it also gives us an opportunity to start to look at some of these tax inefficient investments and sell them and realize some gains as well.
Interesting. So you say realizing gains. I know we talk a lot about trying to reduce taxes, try to offset gains. So you're saying we'd actually want to realize gains and maybe, add to our taxable income?
Yeah, Bob, I realize that it's a little bit of counterintuitive, but there's a couple of reasons why you might want to realize gains right now. For one, if you are doing tax loss harvesting and do have some losses banked this year, maybe now look at some of those investments that you had that have large gains on it that you want to just trim down a little bit. So you can sell those. Yes, you're going to realize the gains, but good news, you've realized some tax losses as well that offset, so reduces your tax liability on those gains. And also for retirees, what we like to look at is where are you in these tax brackets? So for retirees that are in the 12% tax bracket, they have the ability to realize capital gains and avoid having to pay federal capital gains taxes on that. So you want to make sure where you are in the tax bracket and that you have the ability to either sell or keep investments that you want to hold in your portfolio. But we realize, Bob, that not everybody has the ability to sell funds or sell securities and realize gains, or maybe you don't have the losses to offset and you're still a little apprehensive about paying the extra taxes. Are there other ways that people can kind of get rid of these appreciated securities and still avoid paying taxes?
Yeah, well, this time of year, I know we're probably our minds probably are focused on it's kind of the giving season. So for our charitable giving intentions, there are some ways to obviously get some tax benefits for doing that. And so giving securities or donating securities can be a good way to do that, particularly securities that have some large appreciation that otherwise maybe you have been holding on to because you haven't wanted to realize gains and pay the additional taxes. So a couple of big benefits for donating appreciated property, and that could be, stocks, bonds, mutual funds, even real estate and other assets. One, if you're itemizing your deductions and you give the appreciated security, you can get a deduction on the amount that you're donating. Just like you would for cash, there are some different limits as far as how much of a deduction you can get in any year, and it's different for the kinds of property, cash versus capital appreciated property. So, for example, qualified charities, something like a 30% of adjusted gross income is the max you can get in any given year for donating this kind of capital property. Now, if it's above that, you don't lose it; it just can get carried forward to the next tax year to use. So you're actually able to get a potential deduction for the amount. The other thing that it does, though, that's powerful is it avoids the capital gains that otherwise you might have on a security sale. So rather than selling and then using the proceeds to gift, by donating the security itself, you never realize that gain. It leaves your account, it leaves your portfolio, leaves your estate. When it goes to the qualified charity, they don't have, because of tax rules, they don't have to claim the taxes on the sale of those shares when they, you sell them for cash to fund their various pursuits that they're an organization for. So it helps. It's kind of a win-win in that respect, and a pretty efficient way of giving. Now, in some cases, in a year like this, where maybe there are some assets that may be down, you could donate lost property. Now, it's not as common. But in some cases, if there's an opportunity that you're trying to sell something that you are trying to get rid of for whatever reason, or maybe it's part of tax loss harvesting, but rather than just buying something similar, you say you're doing some rebalancing and you want to reduce that particular asset. Well, in that case, maybe it does make sense to sell the asset, get the cash, and give. So what would you do there? Well, instead of giving the shares, you would actually, in this case, sell them to proceeds for cash. You actually sell them at a loss. You donate the cash of the sale. So there's the potential deduction for the cash gift. And then with the harvested loss, you still have, you have that same potential benefit of being able to offset gains. So again, it may not happen as often, maybe more unique circumstances, something definitely to consider in certain cases. And again, that's where it's a part of good planning and being proactive and working with your advisor, planner and tax advisor, et cetera.
Yeah, these are some really good strategies for clients. But what if I did, what if I don't have enough for itemizing? So, for example, we know that clients have a bigger hurdle when they have to itemize because the standard deduction is as high as $27,000 that they have to overcome. Is there any other way that retirees can give more charitably and overcome this, higher standard deduction?
Yeah, a common strategy that we've talked about certainly more over the years would be something called qualified charitable distributions, or QCD. We in finance we love acronyms, so the QCD, qualified charitable distribution, is one. And essentially what that is it's making a gift to the charity directly from an IRA account. So your traditional IRA, so for example, where you're not taking the distribution from the IRA, having the cash, and then sending a check to the charity. It actually is going directly from the IRA. Now, who can use this or who's eligible for that? The IRA account holders who are 70 and a half or older. So you have to be at least 70 and a half. And there are limits of how much you can donate through this, pretty high limits. It's up to 100,000 a year. But what the point of this is that it comes from the IRA, and those distributions are not added to your income. They're excluded from your gross income. Whereas otherwise, if you take an IRA or retirement plan distribution, that adds to your gross income, taxed as ordinary income. So it's kind of like you're making this charitable distribution. It's coming right from the account, and it never is counted toward your income. It's like getting a deduction right off the top. So for individuals and couples that have maybe are using the standard deduction that are not getting that extra benefit by making a charitable gift, this at least allow them to have that IRA distribution excluded from income. It works really well for folks that are in required minimum distribution phase because they qualify or they satisfy these charitable qualified charitable distributions do satisfy the RMD for the year. So if you're having to take that money out and you're making gifts, you can send it right from the IRA and never have to claim that as income. So it really can be a pretty effective tool.
Now, Bob, if I'm doing that, do I have to send my entire RMD over to charity in order to qualify for this?
Yeah, you really don't. You can really set any amount. Now, some custodians, IRA custodians may have limit or minimums. You might be $100 or a couple $100, but you certainly don't have to fulfill the entire required distribution amount. It can just be a portion.
Okay. Well, not everybody out there is over age 70 or needing to take RMDs right now. Or what are some other strategies for folks that might be a little bit younger than that?
Yeah, well, if let's say someone's under 70 and a half, and maybe right now they're not able to get the extra benefit of itemizing. Someone maybe they're saving or giving $5,000 a year, and that plus their other what would be itemized deductions just aren't enough to clear that hurdle. So one thing that they could do is lump together a bunch multiple years worth of giving and gift that all in one calendar year to exceed the standard deduction and provide that additional benefit. But a lot of us don't like to do that. We don't necessarily want to give one year and then say, great, maybe to my church or favorite other charity. You want to give a little bit every year. So there's another strategy that you can use to do that pretty effectively, which we've talked about this more over the years, is called the Donor Advised Fund. Now, what is that exactly? It's a program sponsored by a custodian, and it's set up literally as a charitable organization, a qualified charitable organization. So you would, as an individual, you would set that up through the custodian, and then you would make gifts to that donor advised fund. So that becomes a potentially tax deductible donation because you're gifting it to the donor advised fund, which is a qualified charity. And then from the donor advised fund, you could request grants out to the charities of your choice. So it's like having making a donation to a charity and then being able to send it out to the individual recipients from there. So it can be an effective way to potentially provide a tax deduction the year the contribution's made. So you could potentially do a lump sum of multiple years worth of giving in one tax year, and then have that count toward the potentially deductible balance. The balance of the gift in the donor advised fund is then invested, and you can select and make recommendations as to how that grows. It could be more aggressive growth, it could be more conservative growth over time. And then again, you'd make those requests when you're ready. So the timing is still under your control as to when you would select those gifts to happen.
So Bob, this almost sounds like you can create a personal family foundation, be able to gift appreciated securities to it, and then give from that foundation at your leisure.
Yeah, it's kind of that a simpler version of that. It's not exactly the same, but it does cut down on having to establish the foundation, have a board that has to meet, have to meet all the different criteria for minimum contributions per year and all of those different things associated with a foundation. So it can be a more simplified way to gift, in large amounts or small amounts.
So this strategy is a really good strategy, and you talked earlier about bunching contributions together and making them all in one year. Could you run us through an example of that?
Sure. So let's take example of these two clients, John and Jane, in their early 60s. John 61, Jane 62. They're currently working, and they have adjusted gross income of $200,000 this year in 2022. So let's say that they typically give, that $5,000 to charity each year, and they're going to plan to do that. That's their intention moving forward. Now they plan to retire next year, and they have an adjusted gross income expected of about $120,000. That's what their plan is figured that they can live on. And based on this year's standard deduction, it's just about $26,000, $25,900 for them. So they have to clear about $26,000 in order to be able to itemize. And let's say their $5,000 gift to charity still isn't enough with their other itemized deductions to clear that hurdle. So what can they do? Well, what if they establish a donor advised fund and fund 10 years worth of gifts? Just as an example, $50,000 in this single calendar year, 2022. They could potentially receive a tax deduction because they'll be over the amount to itemize that would give them benefit against 2022's income. So you'll potentially get that deduction. And they're doing that also in a year that looks like could be one of their highest earning years over the next several. If they're expected to have income closer to 100,000 versus 200, this could be a nice year to make a big gift, to have that impact to reduce that $200,000 of income. Then what they can do is they can direct or request the grants really from the donor advised fund to the charities of their choice. So potentially up to the next 10 years, they could direct the $5,000, have it gifted directly from their donor advised fund, as opposed to just writing the check out of pocket. They've received the tax benefit, but they still have the control as to how they want to gift to their different charities.
Yeah, this is a great strategy. So if you're going to be retiring soon and you're in your highest income years before retirement, get a large deduction now while pre-funding your charitable giving for the next 10 years of retirement.
Yeah, exactly. And that's why, things like this, when we think about, tax planning and being proactive in different strategies, it's really looking at the big picture of not just what's happening today, but what is the outlook over the next few years? How do you maximize where you are in your bracket today versus where you might be in the future? So again, part of that proactive planning to really, give you the most benefit, not just this year, but in future years as well. And speaking of reducing, continuing to reduce taxes over time, not just in any current year, we love the idea of trying to have tax efficient or even tax-free income. So there's some strategies also to try to have more money in a tax efficient way, or more money in a tax-free way. Talk through a little bit about some ways to get some tax-free potential income.
Yeah, so one strategy we talk to a lot of our clients about is trying to optimize the use of a Roth IRA. So a Roth IRA, how that differs from a traditional IRA is with a Roth IRA, you're putting in after-tax money versus pre-tax money. But once that money's in that Roth IRA, it's going to grow tax deferred. And then once you take that money out during retirement, it comes out 100% federal and state tax free. So it's a very tax efficient account for clients. However, with income limitations, not everybody is able to make Roth contributions all the time. So what we like to talk to clients about is other strategies in order to get money into Roth accounts. One strategy that we talk to, especially with retirees right now, is doing Roth IRA conversions. So what that means is that you are taking pre-tax money that's in an IRA account right now, and you are taking that out and you're moving it over to a Roth IRA. So now within that transaction, since you're taking it from a pre-tax account to an after-tax account, you're going to have to pay taxes on that money that comes out of there. So it's important that you understand how much that you can do and how that affects your taxes for that year.
So Michael, we've talked about the idea of saving on taxes, just like capturing gains. And now you're saying we should actually take out money from a pre-tax and pay taxes on it now?
Yeah, that's right, Bob. So it's like, why should I do this, right? So let's look at some reasons why you would want to do this right now. First of all, as I explained, Roth IRAs, they have tax deferred growth as well as tax-free withdrawals. So you're taking money that, if you take it out today, you're gonna have to pay taxes on it, and you're putting it into an account where you're likely never gonna have to pay taxes on that money ever again. And next, if you feel like your taxes are going to be higher in the future, maybe now it's a good idea to take some money out of those IRAs and convert it to a Roth IRA at a lower tax bracket. So a lot of folks, when you first start retiring and you're delaying Social Security, maybe delaying a pension if you have the ability to get that, you have some early years in that retirement bucket where you have lower taxes and you have a little bit more control over your taxes. So what we say is we want to fill up those lower tax brackets. So for example, if you're a client in a 12% tax bracket, you might want to take money out of your IRA today at that lower tax bracket, convert it to a Roth IRA, because at age 72, when you have to start to take required minimum distributions, you may be in a 22% bracket or even higher. So taking it out now at a lower tax rate makes a lot more sense. Next, you always want to have a little bit of diversification with your tax treatment. So you want to have accounts that are a little bit more tax efficient than others. We know that money out of an IRA, if you take that out during retirement, you got to pay taxes on it. So if you have other more tax efficient buckets like a Roth IRA, if you needed additional income throughout retirement, you could use that account to take distributions off of and not have to pay taxes at all. And then lastly, it also makes for a pretty good death benefit to be able to pass on to your loved ones. So we went through the IRA stretch rules earlier. If somebody inherits your IRA and they're a non-spouse, they got to take that money over 10 years. And if it's a large IRA, that can mean a lot of taxes for somebody. Where a Roth IRA, it still needs to be distributed over 10 years if you inherit that account. But remember, all that money is going to come out federal and state tax free. So it gives them a little bit of flexibility to control their taxes a little bit more.
Yeah, that's really important. And you mentioned, things like the Secure Act, and we know that tax laws can change over time. So that's one of the things we're always considering would be, what is the potential for tax rate changes? And the current tax rates were set up in the Tax Cuts and Jobs Act at the end of 2017. And unless there's some change made or making the current tax rates permanent, they're set to go back and sunset to where they were in 2017, that same bracket structure after 2025. So, there's the possibility that even folks in higher tax bracket, 12 to 22 to 24, it could in some cases make sense to even, fill up those brackets if those tax rates end up increasing sometime in the future.
Yeah, and that's a good point, Bob. I mean, we really don't know what tax rates are going to be in the future. We know what they are now. So if you have an opportunity to be able to convert some money at a lower tax bracket today, versus what could be higher in the future, it's always a good strategy to do that. But it doesn't always make sense for everybody. So it's just an opportunity for you to sit down with your financial planner as well as your tax accountant, just to make sure if this makes sense for you. But, not everybody can convert money and pay taxes on it. So there's a couple other strategies that we want to talk about where people that are in those higher income, some ways that they can get money into Roth IRAs. So another strategy that we talk about doing for folks is what's called the backdoor Roth IRA. So the backdoor Roth IRA, what that means is if you currently don't have money in a traditional IRA today, what you could do is you could make a non-deductible contribution to your IRA, and then in that same tax year, immediately convert it to a Roth IRA. Now, unlike the last slide where you have to pay taxes on those conversions, on this one, you don't have to pay tax on the conversion because you're making a non-deductible Roth IRA contribution. So you're making a contribution that you're not reporting as a deduction, and then you're immediately being able to convert that to a Roth. Now, however, you need to be aware that if you do have IRA accounts out there, this strategy may not work for you. So even if you have a simple IRA or a SEP IRA through an employer, those IRAs count as IRA assets when they look at the conversion. So if you converted any money and you have funds in a SEP IRA or simple IRA or traditional IRA, you're going to have to pay taxes on that. They're not going to allow you to just do a non-deductible conversion when you already have pre-tax money in those accounts. So it's definitely something that you're going to want to make sure that you follow the rules appropriately. And then another way that clients could get money into a Roth IRA is through their employer-sponsored plans. So some employer-sponsored plans actually have a Roth version. And so it's important for you to talk to your financial planner about how much should go into my Roth versus my traditional 401k. But above and beyond that, some plans allow for clients to make after-tax contributions. So what that means is you're already maxing out your 401k and you're reaching those limits pre-tax, but you want to be able to save a little bit more. You can put after-tax contributions into your 401k if your plan allows that. Those now become part of your 401k and they're invested. But then once you retire and you roll over that 401k to an IRA, those after-tax contributions, you'll be able to roll those to a Roth IRA and be able to enjoy tax-deferred growth and tax-free distributions. And so we call that a mega backdoor IRA.
And Michael, it's interesting that you made the point about doing it the right way, and that these things are available. Again, you'd have plans. The employers, of course, would have to have the available after-tax dollars. The other thing that could possibly change is you never know what legislation could do. We know last year in the Build Back Better plan that was discussed and proposed toward the later part of the year, never actually went through, but this provision, they were going to eliminate this. The idea of being able to convert those after-tax contributions. So it's something that's it's been on the radar for a while to try to close this loophole. I mean, it is a bit of a loophole for the income limitations for Roth IRAs. So we never know that this could go away in future legislation. So it's certainly something to keep on the radar. But if it makes sense, could be something to take advantage of while it is available.
Yeah, that's right, Bob. So these types of rules are kind of loopholes. Legislation always tries to look at them and decide whether they keep them or take them away. So while we have it, it's best to try and take advantage of them. So it's important to sit down with your planner and make a plan for this stuff and make sure you're taking advantage of it while we still can. But we know that this stuff isn't changing quite yet, but there is some proposed legislation out there, Bob, what are some changes that have been proposed that we might be seeing either later this year or next year?
Well, we know that we talked a little bit about the Secure Act, sort of the original Secure Act from 2020 or 2019 into 2020. And there's a number of proposals to continue to build on that by changing some retirement rules. And the House has actually passed a version of it earlier this year, but it's kind of the Secure Act 2.0. So kind of the second act, if you will, for the Secure Act. And it's still in flux. The Senate's evaluating their own plan. We're starting to get a little bit more rumblings that this does have some legs, and we could see some kind of an agreed upon bill between the two houses, even at the end of the year. But there are some notable provisions that we kind of think could impact some clients. So just a few of them, for example, could be raising the RMD age again. So we know that the Secure Act raised the age from 70 and a half to age 72. And this proposal may change the age to age 75. The current House bill kind of does that gradually in stages over a 10-year period. But that's an important note. Changing the way you might plan for required minimum distributions. Do you keep delaying as much as possible, or does it start to make more sense to take some distributions even before that age? So opportunities certainly would come out of that. Reducing the tax penalty for failure to take the RMD. We talked about how that's a big consequence. If you don't take your RMD, it could be 50% tax penalty. Well, they're saying maybe we would cut that in half, make it a little bit less extreme, cut it from 50 to 25. Also, employer retirement plans could have a little bit more options as it relates to where they put matching contributions. So right now, employers would make matching, let's say 401k contributions to the pre-tax side. The proposal is saying it could allow Roth contributions of employer matching. So for individuals where they're making Roth contributions, they're okay, making that taxable income currently for the ability to put more growth that's tax-free later, that could make some sense. In other cases, maybe that has some negative consequences for folks that are trying to do what they can to reduce their current tax liability. Matching contributions on student loan payments is another interesting proposal, where if you're making student loan payments, employers can turn around and also make a match to those, which could be a nice benefit, right, Michael?
Yeah, absolutely. I mean, especially for those companies that are looking to recruit younger employees right out of college, they're going to have student debt. They're also going to be lower income, so they're going to want these Roth contributions. So these would be some nice changes for them.
Yeah. Just a couple other notable provisions. The catch-up contributions. We know that for folks over age 50, you can make additional money to the annual maximum to retirement plans. Well, this proposal is actually saying, well, for folks in their 60s, we're going to actually, maybe increase that further. So, for example, the House plan has a proposal where the folks that are age 62 to age 64 could make total catch-up contributions as much as $10,000. So it's certainly more than what the catch-up contribution is now for those folks age 50 and over in general. And that this would be indexed to inflation. So if inflation goes up, that contribution limit would go up. Now, the Senate version's a little bit changed the age group. They're looking at maybe an earlier 60s, like age 60 to 63. So we'll see where that goes if that sticks. But another point that's of interest is that the other proposal is that the catch-up contributions for everybody, including age 50 and above, would have to go to Roth contributions as opposed to pre-tax. So that's an interesting change. So if you are trying to make additional contributions to your plan, rather than having those get excluded from taxes, pre-tax side, you'd have to account them toward your income, so it would become taxable, and then they would go into the Roth bucket. So again, there could be some pros and cons to that, depending on the goals. If you're trying to reduce current taxes, or if you're trying to get more money growing in the Roth, and you're okay paying taxes on that now. So we'll see. There's different implications with that. We'll see where that goes as well. And then just another point, there are some additional withdrawals that they could be allowed early, pre 59 and a half, from a retirement plan and be exempt from the withdrawal penalty, the early withdrawal penalty of 10%. So, right now there are some certain financial distress situations where you're able to get funds out and not have that penalty. For certain, if you're in a disability, there's ability to get withdrawals without penalty. This adds a few more, or would add a few more. For example, could be long-term care premiums. Proposal is up to $2,500 a year. You could take out, still would be taxable, but at least you'd avoid the penalty if you're not at that age, 59 and a half. Domestic abuse victims may have, if they have additional costs, could take out potentially the lesser of up to $10,000 or 50% of the balance. Again, whichever is less, they could do. And then terminally ill individuals could possibly take out distributions and be exempt from that 10% penalty if they're under age 59 and a half. So a number of different provisions. Again, like a lot of tax legislation, there's pros and cons with these. So we'll see what happens, but certainly these are things we're following, keeping a close eye on. As your center team will continue to make you aware and have communications as we know more, or if things look like they are going to go into effect.
Wow, Bob. So we really went over a lot of stuff for folks. Are there resources that we can offer to people so they can help to keep track of all this stuff?
Certainly. So first of all, I know we were not able to take questions right now, but please, we encourage you, talk to your planner, have these conversations. I know many of you are already having these conversations on a lot of these topics. It's always a good thing to just have a refresher if it's been a little while. If you do have questions and want to email us, please feel free to do so. Our email addresses are provided here at centerfinplan.com. We have a tax and planning guide that goes out to clients and is available. Plus, we have a number of resources on our site. The resources tab on the centerfinplan.com site has a lot of frequently asked questions pages. There's access to different webinars that we have. So a number of good resources from retirement to tax planning, Social Security, Medicare, a lot of good resources there. Follow our blog. A little plug for our Money Centered, the blog that goes out at least weekly on centerfinplan.com. Just go to our blogs page. Lots of different financial content, personal financial topics, goal setting topics, and just fun topics in general. And then if you haven't already, subscribe to our center newsletter, not only for our blogs, but for upcoming, events, our webinars, other public educational events, and so forth. Visit our site, centerfinplan.com, go to the contacts page and make sure you're signed up to stay in touch with us as well. So good resources, great next steps. Again, we really want to thank you for your time today and for all you do, for your continued trust and confidence in the center and your team. We're always here, of course, as a resource for you. And with that, again, thank you for your time. Have a wonderful holiday season and a great rest of the year. Take care.
Thanks, everyone, for joining us today.